Hello, everyone. Today on the final bar, my guest is Ari Wald from Oppenheimer. I believe, talking to him before the show start, I believe he's going to tell us to take a deep breath, relax. Things are going to be okay. In the short term, though, the market's certainly feeling the weight of the evidence moving lower. Yesterday, obviously a good distribution day. Today, more of the same. Bounce back higher in the last hour and a half, 2 hours of trading. The S&P still down 1.5%. Technology leading the way lower. So continued rotation away from the growth trade into the value trade. We'll see what this means for the long term. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together using the power of technical analysis, using data visualization, quantifying investor psychology, the fear, the greed, the buying, the selling, all of the emotional inputs that drive investor behavior. All of that is reflected in the chart. John Murphy would tell you in his books, and still today when he speaks about the markets. That is the reality of how many of us have been brought up to understand the markets through the charts. And our goal with the show is to illuminate the markets a little bit in terms of what we're seeing and what we're thinking. Really excited to have Ari Wald join me. I followed his work and consider him a knowledgeable analyst and a friend, and I'm excited to get his take. It's a welcome, I think, long-term perspective when we think about the short-term movements, the flickering ticks, the heaviness in the market today, a lot of the offense that's led up through, year end, now really starting to distribute, but it's all about the long-term perspective. Energy, for example, up 2.25% today. So it's not all bad. We just have to focus on the charts that are working and lean into those. Now, we have some great guests. I mentioned Ari coming up shortly today. Next week on Tuesday, we have Jesse Felder from the Felder Report. On Wednesday, the 10th Dana Lyons from Lyons Fund Management and the Lyons Share Report. On Thursday, the 11th, we have Willie Delwich from All Star Charts joining us. Also, as a reminder, on March 22nd, which is a Monday, we will have Chart Madness. This is a bracketology stock picking exercise where we have a bracket of 16 stocks. We will unveil those 16 stocks. Four of us, Greg Schnell, Tom Boley, Grayson Rose, and I will go through the 16, discuss the matchups, pick our final fours and our eventual proposed champion. We'll follow those picks over the next couple months and see how those buckets do. I'm excited we're not doing it today because it would be a fascinating and frustrating discussion, but it's coming up soon enough on Monday, March 22nd. Let's get to our market recap. So, obviously the market's selling off pretty good today. Ended the low of the day was around 2 p.m. and bounced up a bit. So the S&P closing down about 1.33%. It looks just below 3770. Mid caps and small caps down a little more. So this has certainly felt like a continued sort of risk off trade generally, rotating out of the tech, communications, consumer discretionary, leadership. Although I should know communication services was actually third from the top today. It wasn't down with the other sort of FANG sectors, if you want to call them that. The VIX back up around 2850. A lot of movements, obviously comments earlier in the day from Powell and the bond markets. Came off pretty quickly with bond prices down. The TLT down about 0.6%, not too bad. And 10-year yields back above 1.5%. Gold, silver prices both down. We've talked about these long-term charts, and as a contrarian, which I would usually not consider myself, I'm tempted looking at the chart of the GLD, looking at the chart of the GDX. Gold stocks, there's nothing in terms of a positive trend happening yet, but they've pulled back so much. You feel like, wow, this could be an interesting contrarian up move. A lot of that could be the dollar and seeing if there's a bit of an upwards turn there as well. Cryptocurrencies overall mix. Although Bitcoin was down just about 48,000 today, sort of gave a lot of that away in the last couple hours of trading. Let's look at the chart of the S&P 500. We'll sort of start there and then move on. We've talked about this overall trend for a while. The warning signs that we saw December to January to February with breadth conditions overall being fairly supportive. However, some divergences we've noted, stocks above their 50-day moving average, probably the most obvious divergence from what we had seen up until January to February. We've now broken down. I laid out about a couple of weeks ago sort of the four-pronged approach to identifying a short-term market top. So, step one, breaking the first trend line, which is the pink line, starting with the October low, connecting with the December low. That lines up pretty well with some subsequent lows. We broke that. That first thing, right? You keep drawing trend lines, tracking the trends. You break the first one, that just tells you something may be different. Let's look for some further evidence. We did not break the 50 days soon after. We made a new high. We then bounced off the 50-day yet again a couple times, and then finally, as of today, have broken down through and closed down through the 50-day moving average. Anytime you break through anything, it's all about the confirmation. So do we get confirmation Friday going into the weekend that there's further distribution? That's what I'll be looking for. We were getting dangerously close to the 3,700 level earlier today. This afternoon, I'm looking at this thinking, wow, I mentioned the 50-day and 3,700. That all could happen right at this moment. And I will tell you, certain things like the NASDAQ 100 already has broken through its January low. The semiconductor index now already has broken through its January low. The S&P has not yet. Now, obviously, the S&P has the benefit of having things like banks and oil companies and stuff that are doing okay, where the charts are actually going higher, and that's allowing the S&P to not sell off as dramatically as some of those other indexes. Having said that, we've cleared 3 of the 4 hurdles, I would argue, to where you really have to think on the tactical side, more on the bearish perspective. I think 3,700 is that last line, and that's the low from the end of January. I should mention earlier today, I was on the FACE interview with Dale Pinkert, did a really good job for Forex Analytics. We talked this morning a lot about just the overall distribution at 3,700 level, how to think about it. So if you missed it, go to my Twitter handle at DKellerCMT. I have a link that I posted earlier today with that video from this morning. So that's where we're at overall with the S&P. It's worth noting as we're talking about these divergences, as we're talking about breaking the 50-day, if you zoom out not too far, let's be very clear, we are still in a long-term uptrend. And I think that's something that's very easy to forget. It's easy to get caught up in the short-term distribution, in the excessive selling on names like Peloton and Zoom that just get absolutely knocked down hard. Cannabis names, marijuana names that are down pretty heavily recently. It's easy to focus on those and think it's all negative, and in the short term, arguably in last week, it's hard to say that it's anything but that. But over the long term, remember, it's all about your time frame. So if you're a long-term investor, the next month or two could end up giving you the most ultimate buying opportunity in history if you have a long enough runway and if you're patient enough to watch how this all plays out. So again, whether things are good or bad, short-term bullish and bearish conditions, it really depends on what questions you're trying to answer, what timeframes you're operating on. So what the worst thing you can do is make long-term decisions on short-term data. And if I can hopefully talk you out of anything, it would be talking you out of that. With today, energy up, and it's one of the big discussions that I've been having with friends and peers is you've had this rotation for sure away from the FANG stocks into energy and financials, and that's not a new thing. If you look at the NY FANG index, and we look at the relative strength of that index, it's not dramatically that impressive. This actually looks a little better than normal because it has some other things, not just Facebook and Amazon in there. Maybe Amazon is a better example of the point I'm trying to make, which is a stock. Yeah, right. So look at Amazon. Up until the September high, Amazon was a pretty decent stock, a decent bet. And this is part of that FANG trade that really pushed the equity markets higher and higher summer into fall. But from September, Amazon has not touched its long-term high there. The relative strength, that's the highest point. The relative strength actually peaked on a relative basis in July, but that was a very close to a relative high. And from then the relative line has been going down. So the fact that Amazon is now back below its 50-day, it's now closed below its 200-day and followed through with that today. Again, none of that is positive. I would argue if you're looking for decent charts out there, Amazon's not one that I would probably identify as decent or great. I would argue it's one of the weaker charts that you can see. And you can evidence for that is the fact that the scooter ranking, right, out of all the large cap universe from strongest trend to weakest trend on a percentile ranking, Amazon is in the 7th percentile. That is not good. That is in the lower end of it. But having said that, it's still not that far off of all-time highs. Right? All-time highs just above 3,500. We're just below 3,000. And again, that doesn't feel great, but it's not horrible just yet. So I think, again, with some of these, that rotation away from the FANG stocks and into things like energy is not new. What's happening now is you're getting things really starting to break down. You're getting the FANG stocks really starting to break lower, and not just those, but some of the more speculative, juicier sort of work from home types of names that are coming off as well. And other charts that don't impress me would be things like Zoom that are testing, this one closed down through its 200-day yesterday, bounced up just a little bit today, which is interesting, but, testing long-term support there around 325. A break below that, measures a lot lower. It suggests a much deeper pullback in store. So the question are some of these other stocks, energy, financials, and others that have done well, are they able to take up the slack and hold things? Later in the show, after my interview with Ari, we're going to have a segment called "It's All Relative," where we're focused on some of the strongest relative charts out there. We'll focus on the top of the scooter rankings and look at the characteristics of some of the stronger charts. And as a preview, one we've talked about recently, American Express is a perfect example. If you didn't know that the world is ending in the last week in terms of the distribution in the short term, you wouldn't know it from a chart of AXP. And I would be looking at other charts like this that appear immune to what's been happening recently. These are stocks that are holding up just fine and where people are not panic selling. They're actually going in here with potential for further upside. So those are some of the relative winners that I would be looking for, where the price is at or near new highs, where the relative strength is continuing to improve. It's not just American Express. There are other charts out there. We'll hope to tease some of those out together in a little bit. That's our market recap. We need to take a quick break. Back with my guest, Ari Wald. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. It's so good to have you join us every weekday after the close as we look at the charts together, try to make sense of the markets in uncertain times. As a reminder, we'll do another mailbag segment on Friday's show, and we'd love to answer one of your questions on the air. You can email us questions, thefinalbar@StockCharts.com. Hit us up on Twitter at FinalBarSCTV, or on our YouTube channel. Just put a comment below the video that you're watching. We'd love to, again, answer one of your questions on Friday's show. Also, the new StockCharts TV on demand is out and available for you, free to use. All you need to do is go to StockChartsTV.com, set up a free account. All of our content on demand, great interviews like we're having today, all of our shows, all of our hosts and their expertise, all featured on that free app, which is also in all the app stores. So watch it on any device and enjoy the content. I want to welcome on my guest, Ari Wald. Ari is the technical analyst at Oppenheimer, coming to us from the New York area. Ari, welcome back to the show.
Hey, always a pleasure, Dave. Thanks for having me back. We really timed it right with the vol this time.
So, I mean, I don't know when is a good day. Is it a good day to come on when things are absolutely crazy, or is it good on a calmer day? I would, in terms of action, this is a decent day to come on. But I, again, having followed your work and enjoying, meeting with you in years past when you'd come through Boston, you always had a good long-term perspective. So I'm excited to start with, looking at the big picture. What are you seeing?
So the market has obviously been soft in recent weeks. Personally, we try to think less in terms of getting every zig and zag right, and more in terms of simply answering the question, do I want to buy weakness or do I want to sell strength? And our recommendation is to buy weakness, and here's why. So I've included charts of perhaps 12 of the most important gauges of broad market activity, from Russell 2000 small caps to key developed and emerging market benchmarks to high yield credit spreads. The point we're driving home is that each one notched a new cycle high in February. So we're of the view that there's typically a divergence at a major top, where at least one of these averages fails to make a new high to suggest something is amiss. Instead, we see this confirmation as an indication that weakness is a standard correction after a strong rally. And that's why we're still following the roadmap that we're approaching the 1-year anniversary of what is typically a 2.5-year bull market.
It's such a great illustration. And I mean, all of these clearly tell the story. One that jumps out at me is just the advanced decline line, right? Because when you look back here to January, February of 2020, that was one of, maybe one of the clearest tells of the February 2020 peak, was you had a clear divergence with the AD lines versus the market, but you haven't seen that this year, right?
You haven't. In fact, as of yesterday, I haven't gotten today's tally, there were still 80% of the stocks on the New York Stock Exchange above their 200-day average. I mean, that's pretty remarkable after a 6% correction in the market to keep that much, which really I think just displays, and the big strong breadth readings that we had going into that high, is that this is the market working off those excesses. That's the beauty of these charts. It keeps everything in perspective and proportion, and we're still above the moving averages. And with that, and the weakness is a function of the strength going into it.
So our second chart then is focusing on a bit of a thematic read, looking at high beta versus low vol. What are you seeing here?
So in terms of our recommended allocation, we prefer a mix of high beta cyclicals and high earnings growth stocks. Now, of course, the cyclical part is what's working, but perhaps not the tactical idea it was. And conversely, growth is under pressure and needs the base, but perhaps the most tactical idea in the market right now. So first thing to call attention to is that while the rotation between value and growth makes all the headlines, it's what clients want to discuss, for us, it's really been all about high beta cyclicals outperforming low volatility defensives since the March 2020 low. So we're showing a major surge in that beta blue line that really hasn't been captured by the same magnitude in terms of value outperforming growth. Now, the black line shows growth has surely come off here, and how we're framing it, it's in the penalty box. But we do think the scarcity premium on high growth remains an attractive feature in case interest rates aren't yet at the point of reversing a 40-year downtrend. So as an attractive balance, high beta cyclicals gets one exposure to the reopening trade and the overall recovery. We like that. Stick with the cyclicals. While it's the high dividend safety plays that have underperformed by the largest degree, and we think vulnerable to continue to be left behind as the bull market marches on.
We only have about 30 seconds left, Ari, but when you're talking about high beta cyclicals, and your points make a ton of sense for the viewers that aren't as familiar with what you're referring to, give us some examples of groups or names that would fit that description.
So that's going to be financials and brokers, Morgan Stanley. It's going to be industrial. It's going to be energy. It's the sectors that are also in the value index. But here's the thing with the value index. There's also a big exposure to REITs and staples and utilities. So you don't get the defensive play. And also our gripe with the value index is you don't have enough tech either. I think this could be a market where it's tech and those cyclicals, not one or the other.
That's a great take. All right. Thanks as always for coming on. I really appreciate your perspective and a voice of calm and long-term awareness in a short-term crazy day. Thanks for coming on. Stay safe, and I'll talk to you again soon.
Be well, Dave. Good to talk to you. Later.
That's Ari Wald. Ari is the technical analyst at Oppenheimer, coming to us from New York. And again, it is so easy in the short term to get caught up in the short term movements, and there's no denying that we're seeing some short term distribution. And I think the way he illustrated with that first set of 12 charts was fantastic. Which is think of the short term sell off that we've had, the pullback in some of these charts. It's the little tiny bit at the very right edge of that chart. Overall, the trends are still showing you a certain long-term trend. There's a lot of movement that we need to happen from here for the long-term picture to turn, significantly negative. At this point, it is fair to say, and as I've mentioned before, I think if you're bullish over the long term, arguably the thing you should be cheering for now is for a little more, if not a lot more, of a pullback in terms of time and price now, because this is working off all of those excesses, as I think Ari beautifully put it earlier. Great take there. Let's continue on. It's all relative is where we focus on relative strength. I've been quoted as saying by Walter Deemer, who's a friend of mine. I interviewed him not too long ago. We'll be featuring our conversation as part of our season 2 of Behind the Charts, which we just started this week. Started back up with our first conversation with Peter Brandt. We have Walter Deemer, Mark Chaikin, Michael Kahn from Lowry's. My friend Mark Dibble, a former analyst of mine at Fidelity. It's going to be a lot of fun. And my conversation with Walter brought me back to when he heard me say to him, I never look at a chart without relative strength on it. And it's probably true. If you follow the show for a while, you can see that the line at the bottom of my charts is 99% of the time a line that looks like this, which is the stock relative to the S&P 500. Because what I learned, working for institutional money managers, if you want to outperform the S&P 500, you have to own stocks where this line is going up. And if you expect to underperform, then your portfolio is and should be full of stocks where the line is going down. So we won't. It's very simply, you want to own stocks, own charts where the relative line is going up, and then that's not changing. And so I would encourage you at a time like this, when it feels like we're in a rotation, when it feels like there's a lot of movement, focus on stocks that are performing well on a relative basis. What's interesting and what's hopefully very helpful to you is we have a built-in ranking model based on trend. And so we have a way of measuring relative strength in a fairly consistent way, which is the Scooter ranking, the StockCharts technical ranking. Now, I'm using ACP for this. I often use the sharp charts. And again, I find both of them very, very helpful for different reasons. But the way that we've designed ACP actually makes a review of the Scooter's ranked stocks really, really easy. If you bring up ACP on the right, you sort of have this toolbar. And if you click on the little trophy, this opens up the Scooter rankings. It'll start with the large cap stocks, but you can switch to one of the other lists if you like. And then below there, it starts with the top 10. So these are the strongest 10 charts, ranking all of them in order from strongest trend to weakest trend, with the strongest at the top. And what you're going to notice if you look at these names, it's a lot of media stocks, it's a lot of energy stocks now, and some random other things mixed in there. So let's look through these top 10s and see which stocks have been holding up. And you'll notice, I think, pretty consistently is that the relative strength line is headed in the right direction for these names. We start with Discovery, and DISCA is the ticker. This is a stock that's obviously had an incredible run starting the clock on November 1st. It pretty much came out of the lows and just shot to the upside. Now, a lot's happened recently. Discovery Plus was announced, and that's really fueled this latest move higher. And overall, today up almost 2% on a day when the S&P was down almost that same amount. So overall, the short-term movement has been relatively strong. I get questions on, is it too late? Did I miss this? And I've had that question on Discovery since right about here, which is when it broke to new highs. And I was told, I was asked, wait, well, hold on, did we miss it because it's already at all-time highs? And I'm thinking, well, don't confuse the top of the page with resistance, as we've mentioned many times before. Just because something hits the highest level it's been in a while, if not ever, that doesn't mean it can't continue to go up. And I think when a stock is going to new highs, you want to get into trend following mode. The challenge that you have right now is it's accelerating to the upside. And those are tough stocks to buy into because you're buying into a very demand fueled rally, and you're just adding to it. There's no overhead supply here. There's no one selling into this necessarily. And you can tell by the fact that the chart just keeps going up. So, looking for actionable pullbacks on something like this makes a lot of sense on a tactical side. But overall, the long-term trends remains very positive. Something that's maybe a little earlier, even though it's also had a pretty good run, is something like Viacom. There are others in this sort of entertainment group I would take a look at. Disney is in this group, obviously, as well. Same thing, the trend has been very positive. This actually has been in a pretty good run since March. And if you start the clock at the March market low, this stock has actually been a consistent relative outperformer that entire time. Now, that's actually accelerated in the new year. This is when things have sort of changed a bit, and we've had some leadership rotation. We've had some adjustments, but this group of entertainment stocks has done very, very well. And again, I'm not that concerned by the fact that it's at all-time highs, because charts that go up for multiple months, multiple years consistently hit all-time highs. That's a good thing, not a bad thing. We now rotate into some energy stocks. These trends are a little less extended than something like Discovery and feel a little earlier on. Again, when you look at something like energy and you think, wow, but it's already done, it's had its run. It's clearly not, the chart is not agreeing with you there. And the reason why it's not, you can see that the price continues to go higher, even though it's had a good run. If you look at the last 6 months, you're going to see a chart going from lower left to upper right and think that it's just a blazing uptrend. But look back at the last couple of years, you can see these stocks are not overvalued based on where the price has been historically. They're actually in a pretty decent shape. It's worth noting, as we see this bearish divergence with semiconductors that we'll look at again here in a moment, this was a bearish divergence with energy stocks that definitely did not work out. A lot of the energy names, December to January, had a higher high in price, a lower peak in the RSI. It did not work. You saw that these resolved higher, broke to new highs. The RSI breaks out, and the relative strength remains strong. XCC would be the fourth one. We'll go quickly through the rest of these, and then we got to wrap the show here. What's great about ACP, by the way, once you click on the first symbol, just hit the down arrow, and it'll just go chart by chart. Here's the first consumer name, Tapestry Inc., TPR. You also have TripAdvisor. TripAdvisor is actually in communication services. I thought for some reason I was thinking those were bucketed with consumer. There's sort of that weird hybrid of consumerish communications names, but also again has broken recently to new highs. Rounding out the top 10, we have Capri Holdings, another consumer name, and then it's more energy, Occidental, back to consumer with Kohl's, energy with Feng. If you look at those energy charts, they're all now broken above their June highs, and they all have clear risk and reward. And what I mean by risk is looking at a recent pullback. The chart of Feng is maybe a great place to illustrate. If you look at the high from June, which we broke out of here, you can see we pulled back and tested the breakout level there at the end of January, and then a nice rotation higher. It's just approaching this resistance area from 2019. These stocks could certainly have more to run, and as long as the relative strength remains strong, I think you're in decent shape leaning into charts like that. That is our segment. It's all relative. We need to wrap the show. The 3 in 3 charts in 3 minutes. Here we go. Chart number 1 is semiconductors. Of course, after just showing you the energy charts where I think the bearish divergence didn't really play out, I think we are seeing it play out pretty clearly on semiconductors. We've talked about this a bunch of times recently, this bearish divergence, higher highs in price, lower peaks in RSI, a lot of distribution in the group today with the SMH, which is one of the liquid semiconductor ETFs. SOXX is another one, has now broken down through its 50-day, closed below it, and also got below that January low at 225. I think we get follow through tomorrow, and this is a pretty negative sign. Made a new 1 month relative low, which is not the end of the world yet. And again, these charts overall could remain above their 200-day and revert higher and just be this nice long-term uptrend. But that's going to be quite a give back, going from 220 down to 190. That's another 30 points. That's another 15% below where we're at. So that's the sort of pullback that would still fit in with the context of a long-term uptrend, but alleviate some of these overbought conditions. Chart number 2 is oil services. OIH is the ETF we're looking at here. This chart looks a lot like the chart of Feng. It's looking at the similar sort of price action where you have the high in June. You broke out in January, sort of retested it here, tested the 50-day and broke to a new swing high. Overbought, which is okay. What that usually means is a brief pullback. That's what you saw in December and January. But overall, the trend remaining pretty strong. The relative strength really impressive with that group. Finally, Discovery. I just want to highlight the top ranked scooter names out of the entire large cap universe. This gets the top seating. And again, it's up another almost 2% on the day when the market is down. This is a trend that's, been fairly persistent. Does it worry me about jumping into a name like this that's extended? Absolutely. I think this is, the type of chart that you look for some sort of actionable pullback. And if you look back through this rise, even though it feels like a straight line from left to right, there have been some pullbacks of a couple points along the way that could have given some opportunities along the way. I might be looking for something like that. And again, the relative strength line is a really good thing to pay attention to on a stock that's had a good run. Keeping it as long as that remains higher, and overall, you're going to be in decent shape. Folks, that is our show. Thank you so much for joining us every weekday for the Final Bar. Special thank you to Ari Wald from Oppenheimer, giving us some good long-term perspective. Again, as a reminder, don't get too caught up in the short-term noise and make long-term decisions based on the short-term data. The long-term trends overall still can be fairly constructive. The market can resume its uptrend after it takes a bit of a breather. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.